Yes, Assalamu alaikum.
Assalamu alaikum, sir.
Wa alaikum assalam. Okay, the students are joining or not? Okay, just like they will join side by side. So last time we were discussing about we reached to this point where we are going to apply this capital budgeting technique, and there are few important things we need to understand regarding that. One is the net present value, internal rate of return, then modified internal rate of return, and break-even point. These are very much important because we are going to apply them. And hopefully, last time we start, I did this. If I just recall that. Okay. Gee, we have done this one, this part. The Excel sheet is visible.
Yes, sir.
You people have tried to do this calculation.
Yes, sir.
Okay. So you got some understanding about that, na, how we are going to calculate this net present value and how we are going to calculate PCR, benefit cost ratio. But most important thing out of them is internal rate of return, right? Which we need to calculate because in this case, whenever we are going to apply capital budgeting, NPV is sufficient compared to PCR, so it may not be needed as such. But I just take the leverage of the situation and I just give you the idea about that, okay, what it means and how it can be shown. So actually, thing is that that's if I'm going to generate some more columns. So I'm just going to move this at this point. This. Okay, now you have this value, and last time I have mentioned that basically whenever you are going to find out your net present value, it is going to be calculated, mean to say it is going to be 0 if NPV is equal to 0. If NPV is exactly equal to 0, at what internal rate, at what discount rate you will get this NPV 0, right? So discount rate where you will get this NPV where you will get this NPV equal to 0. That will be considered as internal rate of return, right? So the internal rate of return can be explained this way. It is the rate of return at which the net present value is equal to 0, or all the benefits are equal to all the cost. We need to calculate or find out quickly. Just to find out this, we can definitely apply different strategies. We can change our discount rate, and then we are going to find out this NPV, right? So, but you need not to do all these calculations. Usually we used to do in project analysis, because in capital budgeting some advantages there. You can directly apply the formula of NPV, right, which is available, and you can calculate this NPV for the cash right? Total benefit and total cash you have. So I'm just going to move directly on this data set, right? First of all, this is the original data set, the same data set. All these three sheets have this one and this practice sheet. All these sheets have the same data set. But I'm just going to give you how it is going to be generated so that you may have the better understanding how you can apply that, right? I will just show you the slides quickly, that what the purpose of this doing this. First of all, you will find out the NPV, and this is helping you to find out uh, whether the project or investment is beneficial or not, or up to what time period that is beneficial actually. And then internal rate of return, it is actually helping you to identify at what market interest rate you can take the loan for your business to finance loaning, right? So this credit can be used to finance your business, whether it's viable or not. So actually you are comparing internal rate of return with the discount rate, this market rate of interest. If your internal rate of return is significantly higher than market rate of interest, you may go for loan. You take the loan, you put it into the business, you get profit. Out of this profit, you pay back the interest, and still you have a reasonable sum of returns available to you as a profit. But if discount rate and this internal rate of return are very close to each other, then whatsoever you will get from the business, if you finance through loan, then you have to pay it in form of interest rate. Just like the loan is available at 10% interest rate and your business generating 11% profit, what will happen? 11% you will get from business and pay the 10% interest rate, 1% is left, which is nothing for all those efforts you are going to make for that business. If it is equal to 10%, internal rate of return is 10%, then nothing you have. And if internal rate of return is 9%, still you have to pay 10% out of your pocket 1%. So you are facing some losses. So that kind of situation exists, right? Therefore, actually internal rate of return is helping you to identify whether you should finance your business project or any kind of investment through by taking loan or not. And you have already studied leverage ratio. So leverage ratio is playing vital role because in leverage debt to equity ratio is given. So if you are considering debt is costlier, then you will go for equity, right? You try to increase your equity so that you can generate more finances for your business without more burden in form of paying interest rate. Today I'm sitting in the office, so I don't have the cup of tea immediately available. So I'm just saying yes, yarning thing. I'm just doing by myself here. Okay, there's some difference between modified internal rate of return and simple internal rate of return. The simple internal rate of return is that which is making this balance between total benefits and total cost. Both are going to be equal to each other exactly. But modified internal rate of return is considering reinvestment rate as well. Because sometimes what is happening in the corporate sector or business sector, you are generating your profit over the time and you are paying this profit to the owners, and you know that common shareholders are the owners, and it's not exactly the liability on you that you have to pay every year the dividend, the share of profit to these owners, so you can reinvest them instead of paying it back. So the dividend retained earning, the retained earning is there. That retained earning can be actually substitutes the loan. So on the one side, you are going to reduce the burden of loan on you through more retained earning. And secondly, you are not going to pay it back to the actual uh, these investors or owners who are the common shareholders, and but you are reinvesting. So why they are happy, why they are comfortable, why they are not going to sell your shares because you are not paying dividend? Because they know that whatever amount of money is withheld by the corporate sector is going to be reinvested into the business and will generate more profits. So today we got, let's suppose, if given shareholder got 50,000 profit and he is expecting that this is going to be distributed, but company reinvested. So I'm just expecting, or just like shareholder is expecting, that this profit will increase in the next year. So not only the 50,000 is being paid by the company to me, but some more profit over that. Let's suppose if 10% is the profit rate going on, then extra 5,000 profit will also come with this profit. So let's suppose next year again company face the same kind of profit situation, and 30,000 dividend is going to be offered or announced. Previous year 50,000 is there, so 30,000 plus 50,000, 80,000 plus 5,000 profit over this previous year 50,000 added, so it will become 85,000. So the shareholders, or just like me, I will get 85,000 share profit instead of only 80,000, right? 50,000 previous year dividend and 30,000 next coming current year dividend, but 5,000 because previous year my 50,000 was again reinvested, and so it generated with the rate of 10% some profit. So I will get that as well, right? In this way, this thing will move. So this modified internal rate of return actually incorporated or consider this reinvestment rate. So whenever we are going to incorporate this reinvestment rate, sorry, into our calculation, then this will become modified internal rate of return, because it remains internal rate of return, but now it's modified because it incorporated or considered the reinvestment scenario as well. Okay, just like you may have the data set for the companies in this way, in this format, and just like I'm going to show that, and then you can do this all these calculations just like I'm going to do for you, and then I'm going to share that, and then we are going to actually compare it as well as we describe it, right? So break-even point is what? You know what is the break-even point? The payback whenever the cost is going to be retrieved. Jim, please. You were saying something? G, break-even point. Anyone who can explain this break-even point?
Sir, where profit is equal to total costs.
Oh,
The,
actually you
that
recover
means
your,
the company is not earning any profit.
actually you recover your original investment. Let's suppose you have invested 50 million rupees, 5 million rupees, 50 lakh rupees, and after 3 years of running your business, 50 lakh rupees are recovered as a profit from your business. And it means now, if let's suppose you are going to accumulate that in terms of savings, then after 3, 4, 5, whatsoever is the payback period, you will get this 5 million rupees back. Now it is again in your savings, and your business is now independent of this cost. How much you spend, you recover that, and now this business is going to generate extra benefit for you, right? So this is basically why it is important, because most of the businessmen, most of the investor and corporate sector, they're interested that break-even point should come as earliest as possible, right? Number one, because then they are getting extra profit, the genuine profit. They are considering that we are now getting genuine profit because now business became independent, and we can generate another business, we can diversify, we can expand the business. So in this way they can actually focus on that particular break-even point. Secondly, this break-even is important because sometimes you have to make this decision of exit or close down for a short period of time. In short run, your decisions are shutting down or stop production, and in long run that can. So in long run, your decision of this shutting down actually converted into exit, right? So whenever you are making your decision about shutting down for the short period of time, just closing your business for a while, it actually depends upon your break even. If you go below the break even, then you can make this decision. If you are still working above than break even point, you are not going to make that decision, neither in the short run, not in the long run, right? So that is important thing. So therefore, you will always consider this break-even point as a important, say, corresponding point for making your decision regarding what to do in my business, whether I should keep continue even I'm not going to earn the same amount of profit, or my sales are going to decline, my profits are going to decline, but still uh, I couldn't reach at the break-even point. Therefore, I should continue to produce, right? But if you reach to the break-even point in the short run, you may shut down your business. Even sometimes you can wait, you can produce, continue to continue your production or continue your project, uh, even if your uh, variable cost is not going to be uh, your fixed cost is not going to be recovered, but you are capable to pay all of your variable cost. And but if you are unable to pay your variable cost, then you have to close down, because just like you are unable to pay your wages, you are unable to pay your utility bills, you are unable to pay your rent. So in that case, you are really in trouble. So you try to stop at that point. Nah? So actually, otherwise, break-even point is going to consider both fixed cost and variable cost. But sometime for your convenience, you may continue your because you are expecting that business is going to be a come back from this depression very soon. So I should not close down, or I should keep continue for the better future. So in this way. So companies must recoup their investments for developing new products and installing production facilities while there is still a market for their output beyond reaching a break-even point quickly. Companies hope to earn a positive amount on their investments so long as the product, the time for an investment to pay back its cost has become critical in high technology industry. And nowadays, this high technology industry is very much important because technology is quickly changing. It is going to improve quickly. So sometimes some technology introduce some technological product, but once you start selling that product and yet you are not capable to retrieve your original investment back, payback period is not completed, the new technology, the new product has arrived in the market, and then your product becomes obsolete, and then you are going to lose your market. So that kind of situation is very much uh, critical for the businesses. Therefore, they have to make their decisions whenever they are putting their resources in such kind of field, more technological and more advanced and more variable field in which technology is changing so quickly and swiftly. Breakthrough products encounter competition sooner than ever before, and commercial lifetime can be as short as 1 or 2 years. Patent no longer provide long-term market protections for many types of new products continue to sell, right? This is the problem. I mean, you cannot sell the product for the long period of time because previously people used to take the patent, the copyright, uh, and then no one can copy it, no one can produce such kind of product in the market. So you are the only seller of that particular product, so you can sell at your own price and you can sell for a long period of time. But unless until the new technology or some other competitor has developed some kind of same kind of product, right? But now this thing happens due to this technological advancement. The life of these patents are very short. Mean to say, you got a patent in 2020 for a product and a computer oriented software, some mobile app. And then what happens? Competitive apps are there which are developed for competitive program, have been developed software. And whenever you try to sell more, the new software has more advanced features. Therefore, your software need to be updated. If you are successfully updating it, you're successfully competing it, still you can have your market. But if you are a bit lagged marginally from these new competitors, you will start losing your sales. and in that case you are going to you are losing your profit margins. And once you are going to lose your profit margins, automatically the rate of recovery of your cost is going to squeeze, it is going to be reduced, right? So therefore it will take more time. Let's suppose if previously your cost is going to be recovered in 18 months, now it is going to be recovered in 26 months, right? In this way, or 13 months and so on, it is going to be changed. Just like this example is given, the knowledge-based products in telecommunications and other information technology industries, as well as pharmaceutical and biotechnology. So this is also important. It's not only happening in technological industry, but pharmaceutical and biological firms, it is biotechnology firms, it is also happening, right? Because uh, this is important, that new and better medicines are coming, new and better testing facilities are there, different kind of uh, techniques related to the biotechnology are there. This is the 18-month time period they have mentioned. After 18 months, new technology, new technique, product arrive in the market. Just like a medicine is there for treating arthritis, faces competition from the similar product from Merck within the month for its introduction. So this is within the month, within the 5 months. Sorry, within the 5 months, the competition set in mean they just remain capable to recover their research and development investment by selling this product, which is the totally new innovation, but up to 5 months only. And after 5 months, a new competitor or new competitive product is in the market, and they are losing their market space, because previously they are the just like the monopolist in that particular product, but their monopoly is going to be over, and because the new other competitors are there in the market. So usually it happens whenever one product comes for a specific kind of treatment, other competitors does lost. This is just like it happens in the COVID vaccine. So whenever vaccine or this COVID-19 vaccine has been uh, produced by one company, then other competitors are also doing that same. Many pharmaceutical companies are and even the countries are working hard to find the solution or find this vaccination. So many vaccinations are developed one by one within a short period of time, right? So this is the same thing. Whenever the focus is on a specific market, then definitely competitors or investors are making full effort in terms of search and development to develop that kind of product, which can be used to capture that particular market. So same thing happening in the corporate sector. So breaking even means achieving a net present value of zero. So that is when the present value of the future cash flows equal the value of the investment, because money has a time value. The future cash flows should be discounted back to the same time as making the investment. Some analysts emphasizes this need by referring to it as the discounted payback period or break even point. Discounted break even. So keep this point. Failure to discount future cash flows to their present values that in shorter payback period that are misleading, because they are failed to recognize the time value of money. So I hope the point is very simple and clear. Whenever you are applying this discounting payback period, you are calculating this pair, you have to use discounted value, because future cash flow, even the same amount of money you are saving over the period of time, has low value. So let's suppose if you have invested 5 million rupees, and 5 years are the payback period. Let's suppose 1 million is going to be recovered in every year. Without discounting, you are getting, let's suppose, 5 lakh in 5 years. But once you apply discounting, 5 lakh has the 1 lakh has the same, 1 million has the same worth in 1 year. The same 1 million in which is available after 1 year or in the second year has low value. In third year, 1 million has low value in fourth year. So ultimately you will find it will take more than 5 years with discounted cash flow that you can get this break-even point, or you have this payback of your original investment, right? So this is the situation, mean you discount it. In case of discounted cash flow, the payback period may be longer. The break-even point may come after more time. So this need to be understand this point. So this is important. And previously it was clearly mentioned that all the benefit must be equal to the all cost. So actually net present value is showing the same thing. Sum of benefits are equal to minus sum of cost. So actually if you just equate, mean to say sum of benefits minus sum of cost is equal to 0. So it is just like sum of benefits are equal to sum of cost. So net present value, just like I previously mentioned this net present value formula. So you can follow this. So sum of benefits, discounted benefits, right? 1 over 1 plus I for any time period t minus sum of cost discounted 1 plus I power t equal to 0, right? Equal to 0. And if you are going to use this strategy, this will move on this side. So it will become just like, you can say, if I'm going to use razor, then it will become equal. So total discounted benefits are just equal to total discounted cost. So that shows this break-even point situation, right? So automatically it means actually the purpose of this equality actually shows what that you are showing NPV at present value is equal to what? 0, right? It becomes 0. So after that it becomes greater than 0, positive. So in that case you are going to have more returns. So this shows this example that how break-even point comes. That present value is 0. So NPV is going to be the rise after that. So what it shows actually, before once you are going to start your business, this area shows that you are going to face some kind of initially some kind of losses in terms of net present value. But after that, whatsoever cash you are getting is not going to give you benefit, because still you are recovering your cost. So there's no extra profit actually you are earning. Actually, you are recovering your cost. So this area is the cost recovery phase. After reaching this point, your profit is started. So actually, this area shows that you are earning extra profit, right? So now you have crossed the break-even. Now, in the long run, your profit is going to be a pure profit, right? But before that, your profit or your returns are just uh, covering your cost of production, right? Or cost of producing or cost of providing that particular product. So this is the formula for break-even period. You can calculate by using this net present values, current value and future value, difference between two, and you are taking the negative value, current negative value in negative term, and then after calculating this ratio, you can add with and then you can find out the time period in which that break even is going to be achieved. So now we are going to use the data set, and we are going to generate this sheet, capital budgeting analysis, right? And then we are going to do this. Okay, again, I just mentioned, I think this is visible to you. The 10 minutes are left in this Zoom meeting. This is the problem with this Zoom meeting. So we have to live with it for a short while. So I will try to explain within this time limit. Okay, first of all, what you need to do. So actually, first you try to understand, and then you do it by yourself. I will share the sheet with you, and you can use the same sheet for practice. And when I will share you new data set for other case studies, then you can generate your own sheet, right? And exactly, you can do it for your own data set, whatever you already have for your companies, selected companies. So you can apply the same with respect to your company as well. So first of all, this is the original data sheet. So this is the practicing. Uh, but before moving to this, I will generate another sheet. Um, and this is the capital budgeting. Sorry, capital budgeting. And today is it's let's suppose 20 sorry 404. Your section is B, so 404B, right? So this sheet we are going to generate for you. So first of all, what you need to do, you need to find out these values, whatever is mentioned here. So these are the values. First you need to copy it, because you are going to generate a new sheet. Better to copy as it is, and then make it here. Secondly, you have to copy this. Right now, this sheet is there. First of all, I just want to show you the most important thing. If you just observe what kind of data is available to you and what kind of formulas you need to apply to generate other data set. As you observe by yourself in this case, let's suppose if you observe what values are visible. Equipment cost, what do you think? Equipment cost will be given or not whenever you are starting your business? Ji, Asim, Maruf.
Sir, it will be given.
It will be given externally. Salvage value you can generate, that is also given. Life in years, how much this business will continue. Exactly, you don't know the exact life, but tentatively you can make on the basis of your investment project and on the basis of your machines and equipment. Just like you know the life of a just like the CNG station or petrol station, how much machine has its life. So accordingly, you can identify, or some boiler in some factory. So different kind of machines, equipments are being used in different factories. So every machine has its own lifespan. So you can use that lifespan. Discount rate, that is also given, and reinvestment rate is also given, right? So just like, and tax rate, it is definitely decided by the government. And then you have to have your benefits, annual benefits stream. So just like if I may show you through formula sheet what values are not showing formulas, right? So you can observe by yourself, these are the values, the end year benefits, the equipment cost, salvage value, life in years, discount rate, and the investment rate, income tax rate, right? So all these are the information or data which is externally available, right? Or exogenously given to you. So you should not worry about this data. So first you have these values with you, then you can generate the formulas and you can generate other values. So there is no problem in terms of generating values, right? So first of all, you have to do this, right? Secondly, you have to write down your cost, equipment cost, right? So I'm just going to copy these values to save the time, right? And then I will mention to you that you can use your own data set and you can do the practice with your own information. Mean to say whatsoever you have, you can apply. Mean to say you can change it. You can change according to your own choice, and then accordingly you can do it. Second thing
Excuse me, sir.
please.
सर salvage value क्या होती है?
हाँ जी, salvage value is basically what is ever is left in terms of any kind of your fixed asset or that kind of asset which is usually depreciated. Every year your asset is going to depreciate, right? Any kind of specific asset, and that just like machineries, equipments, tools, furnitures, buildings. So once they are going to be depreciated, and once you reach to the end of this, the whole project, whatever depreciation is there, it need to be excluded, and then whatever book value is left, you sell your product with that book value, and then you can retrieve some returns. Just like you're using a car and you bought it with 20 lakh rupees, and every year it is going to be depreciated 2 lakh, let's suppose, right? So after 5 years, 10 lakh value is depreciated and book value is 20 lakh. You sell it with 10 lakh rupees, at least 10 lakh rupees, and you get 10 lakh rupees as a salvage value. And you know that vehicles can be sold because they are still usable after 5 years. Even they are still usable in Pakistan after 15 years, no issue. But the thing is that whatever profitable life it has, whatever beneficial life it has, is reflecting in terms of value. That is the salvage value after depreciation, after consuming that product in your business. And let's suppose if your product is so much used, just like your furniture is used, and there's no utility at the end of the project, and it is totally wear out, or it is totally depreciated, mean it cannot be used as a table, just like, or chairs cannot be used as a chairs, or just like your fixtures on walls, shelves cannot be used as shelves. They are so much consumed or wear out, then you can sell it at scrap value. And scrap value is different from this salvage value, right? Because salvage value actually reflects the utility of that particular product, which you can, on the basis of that, you can get some extra benefit, right? Extra return. And it is always available, the salvage value is always available only in the last year of your project or your investment or your business. So you are not going to incorporate in the beginning, right? You are going to incorporate in the last end. It is just like you are using your computer, your equipment, machines in the office, and once you are going to wind up your office, you are going to sell them, and whatever money you are going to retrieve, that is showing the salvage value for these. Clear?
Yes, sir.
Okay, now I'm just going to copy this, and actually time is getting short. I'm just going to take your attendance, right? And we will continue from this onward, the next class, right? So copy this data here, and then I will start from this point onward, and then give you the idea that how you can doing your work in this, right? If you want to continue still, because we have still 20 minutes there, if it is not going to be upgraded, we may restart this meeting, right? So you may re-click it and we can restart, so we can continue to discuss that. What do you think? Yasim, Maruf and Zartab, please let me know.
Yes, sir. Okay.
Okay, if it is going to be closed, please click the link again and we will rejoin.